Welcome to Market Insights, informed news and analysis powered by TradeStation. Today is Thursday, February 22nd. I'm David Russell. Stocks are in the midst of their third losing week in four. Volatility is building and interest rates are on the rise. Some potentially significant chart patterns have also emerged on the heels of some important news events. That makes it a good time to take a step back and consider the bigger picture. First, how has the price performance changed? Let's say the current bull move began when the S&P 500 broke out to new highs in November of 2016. Only 3 times during the run did the index have 3 negative weeks in a rolling 4-week period. December of 16 and early 2017, late March and April of 2017, and July and August of last summer. But each of those were pretty minor in the big scheme of things, with total drawdowns of less than 3% at a time. The recent declines, in contrast, look huge. A different climate? Maybe. Next, the charts. Selling intensified on February 5th after the S&P 500 dove below its 50-day moving average. The index briefly tried to claw back above that level, only to close back below it. Some trend watchers may view that as a potential change in direction. Yesterday also featured a higher high and a lower low than the previous session. That's an outside day for you candlestick watchers, usually considered a reversal pattern. It can also be viewed bullishly following a drop, but the opposite after a rally. Given that it came on the heels of a sharp bounce the previous week, this time it may look more bearish. Those are the technicals. How about the fundamentals? Eugenio A. Perez, CFA, is a data scientist at TradeStation Technologies. His equity risk premium model says stocks are expensive based on their earnings, especially when you consider rising yields. He added that valuations only scored a 9 out of a possible 100, even at the market's low on February 8th. For Perez, that's not bearish per se, but it's definitely not bullish. Fast money trader Fausto Puglisi is about as different from Perez as they come, but he agrees with the number crunching quant this time. Puglisi correctly anticipated the first support level when the bears sharpened their claws early this month. His next level would represent a deeper drop to areas last seen in May of 2017. Next, let's think about the news cycle. It's been positive because economic reports like consumer confidence and hiring are near long-term highs. Plus, corporate executives see tax cuts fattening profits. But all those catalysts have been known and may be priced in. Going forward, there are several key events like durable goods orders and GDP next week, and then key payroll data from ADP and the Labor Department the following week. As those numbers hit, thoughts may shift to the Federal Reserve wanting to raise interest rates. Will that make traders view the glass as half empty than heading into the next central bank meeting on March 21st? One last thought. Earnings season is over until mid-April. That may also leave the bulls hungry for any kind of positive catalyst, with a hawkish Fed looming on the horizon. I'm David Russell, and that's today's Market Insight. Be sure to visit our news feed at tradestation.com/marketinsights for more.